Good afternoon and welcome to our Q&A today. We have some questions already fired in the Q&A, as well as just one question here from John, which I'll get to straight away. Um, so John's question that he has asked is number one, how does the exchange rate work when you buy in other currencies like US? I understand you lose some when you're buying it, but doesn't that return when you sell if, say, the exchange rate is the same? If you make gains in US, doesn't that mean you do better with the exchange rate, assuming the Aussie dollar is less than the US? Why would gains in the US on a platform show us lesser amount of gains in Aussie? Okay, so essentially, I'll explain it in two parts, John. Um, I'll explain it in what tends to happen is obviously there's going to be an exchange rate when you're buying US shares. The moment that you actually make the transaction, there's going to be an exchange rate transaction and the brokerage that occurs on the position. So you know that, and immediately your profit and loss would go into the negative because of that brokerage that you've paid. But with respect to the actual currency transaction over time, as you own the shares of the business, you know, the bottom line with international shares outside of the country that you live in and the brokerage account that you have, assuming most of you are in Australia or New Zealand, and I know we do have a few clients in the US and the UK, but you'll understand what I'm talking about here. If you're right about the company, the currency appreciation or depreciation won't make a significant difference over time. If you're thinking very short term and you're using CFDs and you're jumping in and jumping out of positions and a day trader, then there may be a currency fluctuation that might impact your trade over a day. But when I'm looking to buy companies that are listed in the US on the New York Stock Exchange and the NASDAQ, I am not giving an ounce of consideration to what the Aussie dollar or US dollar might be worth in 2 years, 3 years, 5 years, or 10 years. Because if I'm right about the trade, if I'm right about the company, what the Aussie dollar does is not going to matter. Let me give you an example. The Aussie dollar has traded between 50 cents and $1.10. That's the highest it's been in 2011, 27th of July 2011. It was $1.10 against the US. And recently in his February, it was down under 60 cents. It was in the 50s. Now it's traded between about 50 cents and $1 against the US dollar for the last 20 years. You go back to the year 2000, it was 48 cents. Go back to 2011, it was 110. Go forward to 2020, it was back in the 50s again. So the Aussie dollar on average for the past 20 years, in fact, since 1983, when it actually officially got floated onto international markets, its average is 73 cents. And if you actually have a look at your platform today, the Aussie dollar is 74 cents. So it's about where it is on an average. Now, if I buy some US shares today and I spend $10,000 and buy $10,000 worth of US shares of a company, and the Aussie dollar against the US dollar goes up from 74 to 80 cents. Now, I'm going to lose out a little bit because my US dollars that my shares are in the US are worth slightly less. But I'll give you an example. The Aussie dollar. So, for example, Apple went up 3,000% between 2010 and 2020. Now, I'm not suggesting it's going to go up 3,000% again. I don't expect it to do that in the next 10 years. It might go up 200 or 300%. But the difference in the currency fluctuation might be 5, 10, 15%. But if you're right about the company, the share price appreciation in the company is just going to make the currency position, whether or not it's benefited you or whether or not it's not benefited you, is just going to be irrelevant. And I'll give you an example. When I started buying Apple back in about 2012, the Aussie dollar was $1, right? And I started buying Apple then. The Aussie dollar went from $1 to 58 cents over that 10-year period, and Apple went up 3,000%. So I benefited from the share price appreciation, and I also benefited from the depreciating Aussie dollar. Now, right now, people are concerned that, oh, it's the other way. But it swings and roundabouts. It's only going to be the other way with the Aussie dollar going higher for a period of time until it goes back lower. And I shared yesterday, and one of the reasons why I will from time to time talk about currencies, I'm not going to be trading currencies here at Trading Mastery, but I will share with you my knowledge and experience about currencies because I have traded them for 20 years. The US dollar will thrive again, but the US dollar will thrive most likely in 2 or 3 years' time when the economy is recovered and interest rates start to move higher. You see, interest rates in the United States started to move higher in about 2016, and they ended up being 2.25% before the pandemic. If the pandemic hadn't have come along, interest rates in the US this year would be 3%, and the Aussie dollar would probably be closer to high 50s, low 60s, instead of being at 74. But the only reason why the Aussie dollar is going up right now is because of the fact that the Australian economy and the expectation of interest rates is interest rates will be higher in Australia before they will be in the US. That is the only reason. Now, but the other benefit that you get is if the Aussie dollar goes up, let's just assume the Aussie dollar goes up to $1. It probably won't. But if it did go up to $1 against the US dollar again, how does that benefit me? Well, that means that my bang for my buck for buying US shares is significantly more beneficial than it is right now trading at 74. So I don't look at the currency position as being a negative or a positive. I just try to be right about the company. And if I'm right about the company, I buy at the right time and I buy the right companies, it's going to be irrelevant over time. So that's I hope answers your question with respect to the currency question. The second question you have again, can you explain SPACs again? SPAC. I'm sorry, John, I have no idea what you mean by that. I just don't understand the term SPAC. If you could help me understand that would be helpful. Just email in, or if you are in the Q&A, let me know what you mean by that. Or someone else, maybe I'm missing something. Maybe. All right, so let's get to some other questions. Throughout your talks with us, you continually tell us to buy good quality businesses for the long term. Are not CFDs for traders or those with limited capital? If not, what are the advantages? So, Robert, you're right. I am a value investor. And we have really two different types of clients that come on board here at Trading Mastery. And we have lots of different types of clients. We have clients that come on board that have the ability to have a trading account with 50, 100, 150,000. We've got some clients with a couple of $1 million in their trading accounts. And they can use whatever broker they want. There's no skin off my nose. They can use whoever they like. But then we have clients as well that come on board that might be a little younger or in a position where they might only have a trading account with $5,000 or $10,000 in it, or maybe even less. But they would like to participate and buy some of these US growth story businesses that we've been buying, such as Microsoft and such as Google and Amazon and Adobe and these types of businesses, Berkshire Hathaway, that are either hundreds of dollars or, in the case of Amazon, over $3,000. And if you don't have the cash capital to be able to buy them, then you can use a little bit of leverage with a CFD account to be able to buy some of those businesses. Now, obviously with a CFD account with leverage, okay, a traditional CFD account in Australia comes with 10-to-1 leverage. That means that if you had a $1,000 account, you could own up to $10,000 worth of shares. I don't recommend any of our clients ever do that because that's just a disaster waiting to happen. I recommend they only use 2-to-1 leverage out of the 10 that are offered. So that's the only reason why that we have both options here. because it's hard to, if we had Trading Master and we just said to everyone, oh, you got to have a physical share broking account with someone, and that's your only option. Well, that would probably discount 70% of the clients that we have from participating in incredible companies like Tesla that we bought back in July, around that period, that have had 5-to-1 stock splits, and we've made over 160% return on investment now. So I hope that helps explain that. I'd love for it to be a perfect world and we could all just start out with 100 grand and just do it that way. But unfortunately, we've got to try and cater to everyone the best we can. Dave, with respect to different platforms and different brokers, I really, I have no love for any broker in particular. I don't like using multiple different brokers and their platforms, etc. Whether it's markets.com, whether it's Saxo, whether it's CommSec, whether it's any other platform. I just want to make sure, if I'm going to use a platform to show some education or do something with, I want to make sure it's a platform that our clients can easily have access to, and is very easy and simple to use. I personally think the MarketsX platform is wonderful, simple platform to use versus any other platform out there on the market. But I will leave that to others to judge. The MarketsX platform, in my experience in 20 years of trading, is the #1 simplest platform to use for any newbie investor and trader. If you were to jump into another platform like Saxo or IG or CMC or others, and I'm not criticizing those businesses in any way whatsoever, they're just not as easy. It's just not as simple to use. And I think one of the things with platforms, it's really helpful if it is simple. And then people can gravitate and use other sources as they go through. Is there somewhere in the training center that explains the use of an EMA 200 in an analyzer? Mike, I think if you go down to the technical section of the Knowledge Center, in the technical videos, I do talk about the 200 EMA. So that will be towards the bottom of the Knowledge Center. If you happen to find, I'm pretty sure there are, I do recall doing those videos. So if you happen to find that there's not, please let us know at the support team, support@tradingmastery.com.au, and we will come back to you. But if you'd like to hang around, Mike, for the next little while, I'll pull up the platform and I'll just talk you through how we use the 200 EMA in our analysis. It's actually very simple. It's not difficult to understand at all. So if you can stick around for another half an hour or so, and we'll get through our questions, etc., and we'll do that. Can you explain what, if anything, I have to do with my Coke shares? Con, are you talking about Coca-Cola Amatil here in Australia, or are you talking about Coca-Cola listed on the New York Stock Exchange? It's important that I understand that, because I think you might be talking about Coca-Cola Amatil that's had a takeover bid from Coke in Europe. You would get some instructions from the broker with respect. Okay, so you bought Coca-Cola Amatil. Okay, so you haven't actually bought Coca-Cola. Coca-Cola is the US listed company. You've bought the bottling business in Australia, which just happens to be called Coca-Cola Amatil. That's okay. You will get instructions from the broker. I would probably suggest they may be in a trading halt due to the, I don't know this, but I think they've probably been in a trading halt. I don't hold any positions in Coca-Cola Amatil, but I think a few of our clients do. You would get instructions, and if the shareholders agree to the bid from the European bottling business of Coke to buy Coca-Cola Amatil, then your shares would be sold at the price that was agreed, and you would get the money into your trading account. Unfortunately, you don't have any say in the matter, because unless you're having a voting rights, and it's unlikely one person here at Trading Mastery is going to swing the vote. But yeah, you'll be notified what's happening by the broker. Hi, AB. G'day, James. What's your take on the changes at the ASIX? I think you might mean ASIC, Australian Securities Investment Commission, concerning leverage reduction. It appears the changes won't affect wholesale traders, but mostly retail traders. Yeah, look, James, but the bottom line is, and I can tell you this with a bit of confidence because I was a director at a broking business in Melbourne back in 2016 for a handful of months until I decided that wasn't what I wanted to do. Um, ASIC is going to continue to, as we've seen around the world, in the United States, for example, CFDs are banned. There's no leverage in the US. You can ask for a margin loan in the US, but you can't get CFDs in the US. They don't have them. In Europe, they've basically reduced the leverage in CFDs. I think it's down to about 5-1. And ASIC has probably been behind the 8 ball, slow on the changes. And over the next 2 to 3 years, I would suspect, and it's going to happen in March 2021, they're going to gradually continue to remove leverage from financial markets, from brokers in Australia. And in my personal view, it's the best thing they could ever do. I mean, look up right now, if you can, and Google how much money people lost between February and August using leveraged brokers in Australia in FX, futures, Bitcoin, gold, silver, commodities, those markets. It was in the hundreds of millions of dollars of mum and dad investors have got no idea what they're doing. They're getting 100-1 leverage in FX, even more. They're getting up to 10-1, 20-1 leverage in CFDs and shares. They've got no idea what they're doing. And frankly, I hope that they reduce the leverage to 2-1, a maximum 2-1, because we would not have a lot of people that very sadly don't know what they're doing in these markets with us. So, they're going to continue to reduce the leverage. You can be guaranteed about that. And I'm really glad they're going to be doing that. Okay. Jason says, and hi to those of you that have typed in. Hi to Mike, John, Con, all of you that have said hi that I didn't mention before. So Jason's asking, hi, Andrew, I'm keen to add Berkshire Hathaway to my portfolio and have some cash at the moment. Do you believe they are below fair value currently, and do you believe they will rise in price once a stimulus? Okay, so I don't know when the price is going to rise, Jason. I have no idea. So I can't comment on that. What I do know is that over time, Berkshire Hathaway will do exceptionally well as a company. It will benefit from the economic output in the US growing in the years ahead. It has been voted the #1 trusted listed business in the world a number of times. It's Warren Buffett's business. He's never let investors down since 1962. It's my second biggest shareholding. It's trading, in my view, at the moment, Jason, at fair value. So it's not above fair value. I don't think it's trading at a discount at the moment. It's trading about where it probably should trade. Therefore, if someone said to me that they were looking to add Berkshire Hathaway to their portfolio, and what did I think? Obviously, the decision is going to be yours, and it's not a personal recommendation, but I love the company. I've got a number of clients that have said to me, Andrew, I really don't want to buy and sell shares. I just want to own one great business or an ETF. And I've said to them, if you want to own one great business, own Berkshire Hathaway. It's an unbelievable company. We'll do the company profile not next week, the week after, on Berkshire Hathaway, and share with everyone a little bit more about it. It's never going to shoot the lights out. It's not going to be a Tesla. It's not going to be an Apple and Amazon and do those sorts of PE ratios and those sorts of share price gains. But Warren Buffett with Berkshire Hathaway has averaged about a 23% gain every year since 1962. It's had share buyback programs that continue to help the price appreciation of the business. So I love the company. I love the management. People are concerned about Warren Buffett now being 90 and Charlie Munger being 96. These guys are some of the smartest guys you'll ever meet. They've got people that they've been training up and on the board of directors and in their office and scattered around the US that work for them privately. at Berkshire Hathaway that will take over the reins when they leave. Todd and Ted and Ajit and people you can look up. The succession plan has been in place for more than a decade. So look, you might say I'm a big fan, Jason. Could you please explain HIN and CHESS when buying shares? Yes, Graham. So when you're buying physical shares, you have the option. This is really just to keep it simple. You have the option, Graham, of placing the trade on your platform and saying, I'd like to buy some BHP shares. And instantly the broker will buy those shares for you. And if you like, as I do, this is the way I do it, I allow the broker to actually hold those shares on my behalf. Now, if you want to say, no, I want the shares registered in my name at the Australian Stock Exchange and not registered in the broker and have him hold them for me, I want to actually pay a little bit of an extra fee to have them registered in my name. You can set up and have what's called CHESS sponsored, and you will get a HIN number each time you place a position. So that's really the difference between the two. If you're a little skeptical about whether or not you trust the broker to hold the position, hold the shares for you, then you might like to go down that option with physical shares. But that's basically the way it works. So I hope that helps you understand that. Okay, so Mark, you're looking. You're saying that you've got a situation where they're asking you for an LEI number. This is something that has been required by. If you were to set up, even here in Australia, I had to do this as well. Everyone has, all the other clients in the conference room now would have to do this as well. If you have an account that's in a company name or family trust or what we call here in Australia a superannuation account and a self-managed super, for money laundering reasons, brokers, reputable brokers, will require you to have that legal identity number. Now, you should be able to pretty quickly Google. For example, we could probably do it right now. There you go, LEI Direct. I don't know. I think I use the company in Australia. What is this one here? Is this what we're looking for? LEI. I think the one LEI Australia. There we go. Here we go. You may be able to use these guys from South Africa too. So you can just go to their website. Here we go. You can get it in a couple. This is the one that I used, Australia LEI. If anyone else here wants to type in the company they used, if they've had to set up an LEI for their, it's basically, in my view, Mark, it's a bit of a rort because none of us are in the business of money laundering, but brokers are required by law to do it. I think it was, what was it, about $50 or something like that. And this Australian LEI company, incidentally, is actually not based in Australia. They're based in Europe. They just called themselves Australian LEI. So you can do it that way. I think that's what you're referencing in your question, Mark. Jumping in late. Hello, Beck. I'm here to see if you talk more about the new settings on the Markets X. Also would love an explanation of CFD and the new non-leveraged CFD versus buying actual shares. Apology. Okay, I'll get to that in a few minutes, Beck. And I only say that because I'll actually go to the platform. Is it the same with the ASX? No. Well, I don't use a HIN or a CHESS in the US. I just leave them with the broker. I don't tend to find a lot of traders actually set up the chess and the hin, to be honest, Graham. But there are some older clients, more mature clients that have been around for a long time, prefer to do that. But you generally should be. I'm pretty comfortable not doing it, but that's entirely up to you. No, I don't believe you will have to fill out that form, Dave. I certainly haven't had to fill it out. So the form you're referencing, I'm not aware of other brokers that require clients to fill that out. In fact, I did see the other day that CommSec were actually not accepting any clients that wanted to trade international shares, which just seemed really crazy. But they obviously have their own reasons. Okay, so SPACs are special purpose acquisition companies. They are blank check shell of companies designed to take companies public without going through the IPO process. I wouldn't be interested, John, in those businesses or buying them. They just wouldn't meet my criteria as a value investor to look at something like that. David, are you saying, Stacky, that you use Bloomberg for your LEI? Okay, so that's another option, Bloomberg. Hey, Stacky, can you put into the Q&A just the website, if you could? All right, so what I'm going to do now is I'm going to go to the platform. So you can go to the one that was set up for me here. So if I actually just change this, I don't like to have it white. I like to have it black. So you have to excuse me, guys. This was because I was one of the original markets.com clients in Australia. I actually have my accounts at Barclays in London, and therefore I don't get many of the advantages that you guys and girls get with your accounts here. So the platform and everything looks exactly the same, but basically I can't actually, due to regulations in the UK and Europe under the license. Markets.com is a very significant business in global markets. It's actually owned by a parent company called Playtech, which is listed on the London Stock Exchange, and they own a clearing business, which is, I won't go into what a clearing business is, but it's a very significant business in the financial services industry. They also own another business called Trade Tech, and they also own Markets X, and they own another business called Markets I. So this is basically, Beck, what the platform looks like. It looks exactly the same. It's no different. The only thing that you'll see is that it just doesn't have other markets down the left-hand side here. It just has shares. So it's no different in the way in which that the platform operates. When I was actually testing this the other day, I actually just using this particular account, I just put a couple of very small positions in with ANZ down at EDI to make sure it was all working. About 10 days ago. But really, the difference, probably the easiest thing to do is watch the video that I sent out yesterday. But the key statistics here will show you that it has 1-to-1 leverage. Okay. Now, to move between a leveraged CFD account, which would have 10-to-1 leverage, and a leveraged 1-to-1, up here, where it says CFD, let me just move that out of the way. Here, you'll see if you were to click up here on this button right here, you would see you would have CFD Real if you've got a real account, and demo if you want to switch to a demo. And then underneath that, you would have a new CFD Real, and a new CFD, so a separate one. You could just switch between the two. So right now I'm on the non-leveraged account, and I can place trades. There's $5,000 here. I can hit the buy button and essentially buy shares of Downer EDI, and the spread that you would pay would be the commission you would pay. You can see here there's a, let's go to ANZ. Here's an example here. You can see here that if I wanted to buy 10 shares of ANZ, that's going to cost me $233. And the broker's going to make $23.32 to $23.37. So that's 5 cents. 5 cents times 10. That's what I'm going to pay in brokerage. And you hit the place order button and it works exactly the same. You just don't have the overnight, with a one-to-one account, you just don't have any interest charges or margin requirements to hold, because there's no leverage. Now, if you have an account right now with leverage, then you will see up in the top right-hand corner, you can switch across to the other account, and you'll see the video they sent out yesterday shows you how to transfer funds. But you need to be very careful that if you already have positions in the market on a leveraged CFD account, if you do happen to have that, you need to make sure you keep enough money in that account to cover the positions you have before closing any. Give that consideration. But you can move the cash, you can transfer straight across. If you go to where it says My Portal, and I show this in the video, hit funds transfer, and you can choose the original account and transfer to the second account, put in the amount, hit transfer, and it will transfer money from one account to the other one, and it's instant. So it doesn't take a day or whatever to show up. It's actually instant in the actual platform. So that website that Stacky referenced before for Mark in South Africa, the website for Bloomberg is, it would be www.lei.bloomberg.com. I don't know of a website, Brad, that can filter that down for you. You might be able to find one, but I don't have one, or don't use one myself. That's right. So if you don't want to have a leveraged account, Beck, where there is leverage on offer, then you would, if you have positions on a leveraged account, you just close them, transfer the money across to the non-leveraged account, and then re-establish the positions there. That's exactly right. Yeah, look, there's probably websites out there, Brad, that you could search up and find. Monish Paprai, a guy that I follow, he's always talking about PE ratios of 1. There's probably websites you can find. They'll search for companies. There's 50,000 listed companies around the world on financial markets, and there's probably a website somewhere that you can subscribe to, and they'll tell you the companies that have got PEs of 1, or EPSs of 10, things like that. I tend to find that there can be a little bit of analysis paralysis if you start doing that stuff, because I just don't think it's that complicated. I really don't. I think that I think for the average investor, that if you take the attitude that you're not going to look too short term. And I respect we want to be able to get some money out of the market at some point. But the reality is, if you're thinking 6 months or less, or even sometimes 12 months or less, it's just a heck of a lot more difficult to really get a meaningful return. Something that's really going to, that's going to come with a relatively low level of risk. And therefore, most of the time, I use the philosophy that probably 90% of my money, more than that, I'm going to make sure that I'm buying great quality businesses when they're cheap. And I'm just going to keep buying more of them over time. But certainly there's a certain section of my money, and this suits my temperament, it may not suit others, that I do want to take an opportunity from time to time, where I can see there's significant upside in a business that a lot of big money investors are investing in and buying. I know that because I've done my research. The average person won't be doing the research that I'm doing, with respect to David Tepper and all of these guys that have recently been buying PG&E. And by the way, they might be wrong, but the thing is, I'm not going to expose myself to a significant risk in a position where I might get a 5-bagger or a 6-bagger in the next 5 or 10 years. I'm going to put the vast majority of my money into businesses that I trust and I know are likely going to be here in 50 years, but I'm just going to try and buy them when they're cheap. And I just think there are enough of those businesses around, household name businesses that will serve you well over time. And it's just a matter of waiting for them to be in the sweet spot before you swing. And that comes down to the temperament. And I think a lot of people make mistakes from time to time. Every now and again they get lucky. And good on them for doing that. But you've got to really, if I met someone and I said, look, tell me a little bit about the portfolio and the businesses that you've got in your portfolio, not particularly here at Trading Mastery, but just generally investors maybe in my neighborhood here or around the place. And they said, oh yeah, I was told by this person that I should own some of this company and that company and another company. And then I said to them, well, tell me about those businesses. What do you know about those businesses? What do you know about the management? What do you know about the competition? What do you know about its past history? What do you know about its profit? What do you know about its EPS or PE ratios? They just wouldn't be able to tell you. And that's where the advantage comes in for the investors that have the knowledge about wonderful businesses and being able to buy them when they're cheaper. And like we always talk about here, you'll never get the opportunity to buy a private business at a 30 or 40% discount, because they would be stupid to sell a private business for that sort of discount. Why would you sell a private corner business that wasn't on the stock market for a 30% discount? So you're never going to buy an incredible business at a 30% discount. But because in the share market, prices are quoted every single day and people have the opportunity to buy and sell every single day, every now and again, a group of traders around the world collectively will act like a herd, like they did in February and March, and drive the price down, and you can buy amazing businesses at incredible discounts. That doesn't happen anywhere else other than the share market. It doesn't happen in the property market. The property market doesn't fall by 30 or 40%. The S&P 500 has fallen 3 times since 1974 by 50% or more. It's fallen 18 times, 15%. It's fallen 12 times, 25% in the last 44 years. So the knowledge of that sort of stuff, like I'll just give you a general rule of thumb. I will be very aggressive in my own portfolio of adding to my portfolio if the S&P pulls back 15% or more. So if you see the S&P for 500, let's just call it, it's, what is it, about 3,600 at the moment. What is the S&P? About 3,600 at the moment. And they're talking about it getting closer to 3,666, 4,000 by the end of next year. But let's assume that it fell by 15% from here. So it fell by, what's that? 360 is 10%. So another 5%, 500 points or whatever it might be. If it went back down to 3,000, then I would start to be aggressive, because I know historically that over the course of the last 50 years that the S&P has always recovered. It may go down 25%, it may go down 30%, but the further it goes down, the more incredible businesses are going to be on sale, and I'm going to have an opportunity to buy them at cheaper prices. And this is where it really defines the great investor from the average investor, because the average investor just wants to buy when the market's going up. It makes them feel good. Like right now, the ASX 200 has been outperforming most other markets around the world since the federal budget. And there's a lot of money coming back into the market right now. People will be buying at the highs constantly. And eventually someone will get burnt, because they'll be the last buyer. They'll be the last group of buyers. And I don't want to be that type of trader. I want to be buying when everyone else is fearful. And so if the S&P, whilst, I don't expect to buy again until 2021. I've basically spent the money that I want to spend. I've bought PGN and Occidental this week, and I don't intend to buy anything else for the balance of this year. If I did have 50 grand available, then I would buy Boeing. And that's not a personal recommendation, but I just don't. My portfolio, I can't own everything. There's always businesses out there that prop up even when your portfolio is full, that you say, gee, I'd love to own that. That's really just giving yourself anxiety if you always think that way. I used to think that way all the time. I'd always want to own everything. And in the end, you may as well own an S&P 500 ETF, because you've got 30 or 40 companies. And that's not the way to get better returns. You want to be able to look for opportunities where the market's in your sweet spot. It's got a good margin of safety because it's pulled back. Great quality businesses. Find out, make sure there's nothing wrong with them. Like back in March, when we started buying into many of the businesses we still have now, we were making sure that there was nothing fundamentally wrong with those businesses. But you look at a business like Telstra or AMP here in Australia, those businesses have got major problems, and I wouldn't touch them. But you look at a business like PG&E, that's had major problems as well. But it's a different scenario for me. So you've just got to do your research and make sure you know what's going on when the market does pull 15% or more, but that's when I'm going to be aggressive. I was shocked the other day when a mate told me his managed fund returned 13% with 5% fees. We are lucky to have you. Thank you, Steve. Well, look, that's sort of like 5% is a lot for fees. That's just a flat out rip off. But probably the best. No worries, Kerry. Take care. Probably the best example of a managed fund, and I know I'm a big fan of his, and I know you probably get sick of me talking about Warren Buffett, but the ethics of the guy is just incredible, and the way he operated when he actually did have a managed fund. I don't know if many of you know that he actually did have a limited partnership back in the 50s and 60s with a handful of his family members and friends. And does anyone know actually how that was set up? Does anyone know how that was set up? Because Monish Paprai actually set his up exactly the same way. Can anyone tell me how it was set up? I'll tell you. I was just interested to know whether or not anyone actually knew. So Monish Paprai is a guy that I like to follow as well. And you can watch you can subscribe to his YouTube channel. There's lots and lots of great videos there. He goes and talks at a lot of universities in the US. And anyway, so he basically copied Buffett's formula with respect to the way he wanted to raise money for his personal fund. He had some people that didn't want to invest in the market themselves, and they were happy to give their money to him because he'd turned sort of $1 million into 10 million, and they figured that was someone they were going to trust. So he started this limited partnership. Anyway, the way it worked was there were no fees whatsoever and no management fees. And the first 6% of any profit went straight to the investors, and anything above 6%, he took 25% off. So but there were no profits at all. Sorry, excuse me, no fees at all. But here's the kicker: he guaranteed the downside. He said, if you put in 1 million, if you put in 100,000, if you put in 200,000 or 500,000, I'll capital guarantee you $1 million. So that's the integrity of the guy and the confidence that he had in his system. And Manish Paprai did exactly the same thing. You can look it up and look it on his YouTube channel. He'll tell you. And then it got to a stage where he had so many people wanting to come involved, he wasn't able to do it on scale and get his fund to close to $1 billion now. So basically, he gave investors a capital guarantee. There was zero management fees. The first 6% all went to the investors, and anything above 6%, he took 25% of. And he compounded their money at about 23, 24% per year. And then he just decided that he didn't want to run money anymore. He just wanted to run Berkshire Hathaway and buy companies and compound money that way. So he closed the limited partnership and continued with Berkshire Hathaway. Beck is asking, secondly, just wanted to tell you my very tiny portfolio is 30% up on original investment. And I want to say thank you for teaching me, even though I am slow and don't get it most of the time. What you teach works, so thanks. Well, Beck, I'm so pleased that you and Scotty have got that, because, you know, it's just the start of things to come. I can't promise you that things will be like this year every year. One thing I have learned here in the markets in the last 20 years, if the market's been really kind to us for a period of time, we shouldn't expect that to continue for much longer. So whilst most of us that have been in the game for a while, and particularly this year, you know, there was a period of time, and I do say this with my tongue in my cheek, that it was a little bit like sort of in April, May, June, that period, making money in the market this year was a bit like shooting fish in a barrel to a certain degree, so long as you were just buying great businesses, because they were just so cheap. And there was so much money coming from central banks and governments to stimulate the economy, to ensure financial markets didn't suffer any further. So therefore, we saw this huge confidence come back in the market. So we just shouldn't expect that things are going to always be like this year. You know, we're going to experience together, all of us, in the next 3, 5, 10 years, we're probably going to have the odd year where the market just is completely flat and doesn't go anywhere, and you get quite anxious and just frustrated. And that's where delayed gratification skills comes in. And, you know, I think it's safe to say, so many of you, particularly Beck and some of you others that have just joined us this year, that have really come from a background in the corporate world, and whatever that might be, you might be a school teacher or whatever it might be, into the financial markets, where much of it, when you first start, it just doesn't make sense. And I can't begin to tell you how important experience is in financial markets. Experience really in how you deal with situations yourself internally, how you manage the emotion of getting up every day and seeing the markets up and seeing it down. And I know what it's like. I mean, don't get me wrong, I love to get up every day and see the market green. And there's always that feeling of, you flick on your phone or you flick on the computer, and is the market going to be red? Is it going to be green? Of course we like to see it green. But one thing that I've realized over time is that seeing it red actually is really what I want to see more of, like, every now and again, because I don't want to see it green all the time, because if it's green all the time, it doesn't give me an opportunity to buy great businesses at a discount. So, you know, and we're probably going to see I guess what I'm a little bit concerned about, if I do have a concern, is by this time next year, all of the businesses that are trading at a substantial discount now have all come back to fair value, and there really isn't anything trading at a discount. I mean, there always is a business somewhere that you can search out and find, but they're much more difficult to find when the global economy is doing really well. I mean, we go back to the end of 2019. My wife and I and the kids were in the States over there, and you walk around the shopping malls, and virtually every window's got a sign in it saying we're hiring. The economy was booming. Australia was doing reasonably average this time last year, not gangbusters, but the world economy was doing pretty well, and the share market was pretty much fully priced. It was pretty hard. It was virtually impossible to find a bargain, where it wasn't very difficult to find bargains a number of months ago, and it's certainly not difficult to find a bargain right now. G'day, Juanita. Hi, AB. I'm absolutely love trading and investing now. When I first started, had no idea what to do or where to look. I'm so much more confident now and have a passion for the markets. Well, that's great. I'm really glad that you made that comment, and I appreciate that. And I don't know whether you guys are interested in actually receiving this content, but I had someone ask me the other day. We have a lot of new people look to join Trading Mastery and want to learn about the markets, and one of the guys in our marketing department came up with an idea of just a series of emails that you could send them over a number of weeks to share them out the stock market. And it sort of came at an appropriate time that our son Jack, our middle son Jack, one of our sons, Lewis, is 23, Jack's 19, and Abby's 17. Well, Jack's over in the US at the moment at college, and he's only got one class that he actually has to go to. The rest of them are all online, so he's playing his tennis and doing that. And then the rest of the time he's spending online. So he's got a lot of free time. And I was quite excited the other day. He sent me a note. He does already own some shares, but he sent me a note and said, Dad, I'd really like to learn about what you do. It's the first time he's ever said that. I'd really like to learn about it. Our elder son, Lewis, many of you met Lewis. He's an avid trader and investor, and he's doing exceptionally well. But I was so excited. So what I'm doing with Jack is I'm writing an email to him every week, and it's just, Dear Jack. And it's going to be it might be 10, might be 15, might be 20 emails that I'm going to send to him each week. And I've already sent him the first one, and I can send it to you guys. There's nothing private in there. It's just, Dear Jack, these are my lessons that I've learned over the last 20 years trading. This might help you. Love, Dad. So if you would like me to send it out to all of you guys, I'm happy to do that, because you might like to share it with your kids or other people that know nothing about the share market. Jack doesn't know anything. He knows what the share market is, but he doesn't know how it works. It starts out pretty basic, and it just basically goes up from there. So if you would like to get it, I might make it part of the one of the emails each week. So no worries. All right, guys. If there isn't any more questions, we might leave our Q&A there for today. Trying to think. Non-farm payrolls is the big announcement in the US tonight. So that's the jobs number. It's always an important number. That'll be the December jobs number. They're expecting about 6.6% unemployment, I think, or 6.8%, something like that. So we'll see what markets do tonight. But at the moment, there's not a lot to get negative about. I just was a bit cautious today in the report to everybody, because I don't want everybody just falling in love with the fact the market's been so bullish in November that it's just going to keep doing that in December. Because those of you that have been with me for a while just understand that's not going to happen. We're not going to see another rally of 10%. If we did, it would be a world record. It would be unbelievable. And it just is very unlikely to happen. So we just have to keep our temperament right. We have to be patient. We have to just look after the important things. And that's health, number one, and family, number two, money and other things, number three. Have a great weekend. I'll see you on Monday. Bye-bye.